Welcome to Journey to Financial Freedom. Today, we're laying the foundation. What is investing and why is it so important? If you've ever wondered how people grow their wealth without working endless hours, this is your starting point. Investing is the secret to making money work for you. And guess what? You don't need to be a financial expert or start with a lot of money to do it. By the end of this video, you'll understand key terms like ETFs, dividends, and the stock market. You'll also see how small, consistent investments can grow into financial freedom over time. Ready? Let's dive in. At its core, investing is putting your money into something with the expectation that it will grow over time. Think of it as planting seeds. You nurture them, and they grow into trees that bear fruit year after year. There are many ways to invest: stocks, ETFs, real estate, even gold. The goal is to make your money work harder than it could sitting in a savings account. Why? Because inflation erodes the value of money over time. Investing helps your money not just keep up with inflation, but beat it. Imagine you save $100 and leave it in a drawer for 10 years. Thanks to inflation, that $100 might only buy what $80 buys today. But if you invest that $100 wisely, it could grow to $150, $200 or more. Now, let's explore some key concepts you need to know. Stocks are ownership in a company. When you buy a stock, you own a piece of that company. If the company grows, the value of your stock increases. Think of big names like Apple or Starbucks. If you owned a share, you'd benefit as they expanded worldwide. Owning stock also means you have a stake in that company's success. For example, if Starbucks opens more stores and increases its profits, the value of your share goes up. Some companies even pay you dividends, which we'll cover in a moment. If you'd invested $1,000 in Apple stock in 2003, it would be worth over $300,000 today. That's the power of owning strong companies. ETFs, or exchange traded funds, are like a basket of investments. Instead of picking individual stocks, you invest in a group of them. For example, a technology ETF might include companies like Apple, Microsoft, and Google. It's perfect for beginners because it spreads risk across multiple companies. Think of an ETF like a pizza. Instead of buying one topping, you get a slice that includes pepperoni, mushrooms, and cheese. This diversification helps reduce risk. ETFs are also managed by professionals, meaning they decide which companies to include in the basket. This makes them a hands-off investment tool for beginners and even experienced investors. Dividends are a reward for owning a stock. Some companies share a portion of their profits with shareholders. And here's the magic. Reinvesting those dividends accelerates growth through compounding. Let's say you own a stock that pays $50 in dividends annually. If you reinvest that $50 instead of spending it, your total investment grows faster. Over time, this reinvestment creates a snowball effect where your earnings generate even more earnings. Now, let's talk about macroeconomic signals, the big picture factors that impact investments. Things like interest rates, inflation, and unemployment affect markets. For instance, when interest rates are low, borrowing becomes cheaper for companies, and their stocks often rise. Low interest rates also encourage people to invest in riskier assets like stocks rather than keeping money in savings accounts. On the other hand, during high inflation, assets like gold tend to do well because they're seen as a store of value. Gold doesn't generate income like stocks, but it holds its value during economic uncertainty. The biggest mistake people make is waiting for the perfect time to invest. The best time to start was yesterday. The second best time is today. Even small amounts matter. Let's break it down. If you invest just $5 a day in an ETF that grows at an average of 8% annually, you'd have over $200,000 after 35 years. That's the power of time and compounding. Imagine a 25-year-old who starts investing $100 a month. By age 65, they could have $400,000. If they wait until 35 to start, they'd have just $200,000, half as much. Time matters more than the amount you start with. Now, let's address some common myths about investing. Myth 1: you need to be rich to invest. Not true. Platforms today let you start with as little as $5. Myth 2: investing is too risky. Every investment has risks, but diversification, like using ETFs, helps manage them. Myth 3: investing is too complicated. If you can understand simple concepts like saving and budgeting, you can learn to invest. It's all about taking small, manageable steps. Let me also emphasize this: investing is a skill you build over time. Just like learning to drive or cook, it requires practice and patience. You don't have to know everything on day one. Your first step is simple: open an investment account. Look for beginner-friendly platforms that allow small, regular investments. Start with ETFs. They're low cost, diversified, and require minimal effort. Set a goal to invest a fixed amount regularly, like $50 a month. Remember, it's not about the amount, it's about consistency. Once you've started, commit to learning. Watch for economic signals like changes in interest rates or inflation. Keep reinvesting your earnings, and don't be afraid to adjust your strategy as you grow more confident. Investing isn't about overnight success, it's about building wealth steadily and strategically. With each video on this channel, you'll gain the tools to grow your knowledge and confidence. Don't forget to check out our upcoming videos, where we'll dive deeper into reading economic signals, understanding gold prices, and building a balanced portfolio. If you're ready to start your journey, subscribe and join me for the next step in achieving financial freedom.